I hope you're all well and staying safe. My name is Ralph Biederman, and I'm the Executive Director of the Mid-America chapter of the U.S.-Mexico Chamber of Commerce. This is our 8th webinar and a 5th that has been co-hosted by the Consulate General here in Chicago. This has traditionally been a springtime event, and we have always asked in the past our members from Mid-America chapter to be the speaker. The webinar is going to be recorded, and the presentations will be available at our website in the next day or two. If you have any questions, please use the chat button, and we will try to get them answered depending on how much time we have. First, some words about our chamber. The U.S.-Mexico Chamber is a binational chamber with headquarters in both Washington and Mexico City. The purpose is to build mutually goals on trade and investment relationships between the two countries. We started as a 501c6 in 1973. Today we have 18 chapters, 10 in the US and 8 in Mexico, with a total membership of 550 companies and members. We have a number of task forces, including the North American Working Group, which is comprised of members whose goal is to review and analyze trade issues and then provide some insight to the appropriate agencies of the government. Since May of 2017, we've held 13 live, what we call breakfast sessions with members and friends to openly discuss issues and their impact on their organizations. Since COVID, of course, we haven't been able to do that, although we have provided many updates on issues to this growing group of concerned individuals in the Chicagoland area and elsewhere. And just so all of you know, by registering and attending, you will now be on our mail list. So check us out at www.usmcocma.org, especially our resources page. Our lineup for today, the Ambassador Reina Torres, the Consul General here in Chicago, Hugo Dubovoy, partner with Baker McKenzie, Edgar Lopez Lena and Myra Pena, both international tax senior directors at RSM US, Angel Ramirez, the Mexico market leader and international services practice at Baker Tilly, and Omar Garcia, tax partner at Mazars USA. So with that, Ambassador, why don't you take it?
Thank you so much, Ralph. I really appreciate this opportunity to be in touch with all these good partners that are interested in these issues and that follow the activities of the U.S.-Mexico Chamber of Commerce, particularly the Mid-America chapter. So thank you to all the participants for being here. I just want to leave you with a couple of messages. First, I want to thank Ralph for this initiative that he does every year, and he tackles exactly one of the issues that are more important for the people that want to be part of the exchanges between Mexico and the U.S. This year in particular, we're celebrating our bicentennial, our 200 years of relationship between Mexico and the U.S. But as I said, every time that I speak about the bilateral relationship, of course, is the governments and capitals and what we do, what keep this relationship and partnership between our countries alive. But mainly, and most importantly, is the connections that, private companies, entrepreneurs, people in the business community, students, of course, our community, the families that are binational now, those are the connections that bring to life our bilateral relationships. So that's why this is very, very important. And it may see a very specific issue, the one that we will be discussing today, that has to do with, many technical issues, but it's also very important. And I want to give you two important messages. I want to leave you with these two important messages. The first one is that things, despite the pandemic, things have been moving around. And actually now is a good opportunity to seize, all those opportunities that have been raised by the pandemic. So this is a good time to, reconnect and start planning for the coming years. So this is a good occasion for us to have the most updated information about legal and tax exchanges. The other thing is that, as you know, in the past, the consulate of the government of Mexico had some institutions that, were providing this information or helping to provide this information to all those that were interested in investing in Mexico or in having some trade, establishing a trade relationship with Mexico. But since we don't have those institutions anymore, we have absorbed those tasks in the consulate. So here with Ms. Rocio Rivera, that she heads the newly, built the economic department at the consulate. And we have had many questions throughout these years about precisely the issues that are going to be addressed today. So we couldn't be happier. We have the experts to talk about, legal tasks, fiscal, and of course, the supply chain update. This has been an issue that has arisen, of course, during the pandemic, and that we are still feeling the impact of when these supply chains are interrupted for one reason or another. So we want to have more tools to be able to prevent or to address the problems when they arise, and in particular to be able to strengthen the regional supply chain. We have a framework now. I cannot stop talking about the USMCA because we tend to forget. Once it's signed, we tend to forget that it's there, but it provides a lot of opportunities for potential investors and people that want to increase the trade or initiate trade activities among the two countries. And the other good news, the other message is that the trade between Mexico and Illinois has increased in this recent years. We have reached now, last year, the total was over 24 billion US dollars. So this amount is higher, than what we had in the years before the pandemic. So that's good news. We are breaking records now, and we want to do more. So that's why for us is very important. This event will, all the participants will receive more information and go through the technical aspects of what they need to do, how they can prepare to better perform in the market between Mexico and not only the Midwest, but also the US. So thank you very much, Ralph, for this opportunity. Thank you to the panelists. And I'll be happy to follow and take notes so we can, from the consulate, answer some questions later on. So thank you.
Thank you very much, Ambassador. And we'll be talking at the end of our session because I know you have a couple of things to say about what's coming up next week. So now I'd like to turn this over. We're talking about the technical details to Hugo Dubovoy. Let's see. Hugo, it's yours.
Thank you, Ralph. Well, good afternoon to all. I'm a Mexico licensed attorney with Baker McKenzie's International Group based out of Chicago. And today I will be talking about the Mexican subcontracting reform. This represents a major change in the Mexican labor landscape, materially affecting the dual company structure, which was used for many, many decades. And that basically consists of an operating entity with no employees entering into an agreement with a related entity that has all of the employees in exchange for a payment. Also, outsourcing companies like Manpower, Kelly Services, etc., and their clients, which could include some of your companies. As well, profit sharing, which traditionally had been 10% of the taxable income of all employers in Mexico, who were required to distribute that amount among their employees. And also, depending on the facts, companies sending employees to provide services at their clients' facilities, potentially any kind of service. So that can affect also a very large universe of businesses. The reform amended various laws, including the federal labor law, the Social Security and the Workers' Housing Fund laws, the tax code, the income tax law, and the value-added tax law. Most of its provisions took effect on September 1 of last year, but many companies are still figuring out whether the reform affects them, and if so, how to comply with it. Sometimes contractual parties have opposite views on the subject because the rules are not entirely clear and there are many opportunities for confusion. Now talking a little bit more in detail about each of the items that I mentioned with respect to the dual company structure. As I was saying, for decades, many companies used these structures. Again, having an operating entity with no employees and receiving the services from a related company with the employees, primarily for profit sharing purposes. I mentioned that profit sharing had been 10% of the taxable income in all cases. But by having this kind of structure, the company paying the profit sharing, which was the services company, would pay the 10% based on its profits, which would be smaller than the profits of the operating entity. And this was done many times because otherwise compensation structures could be severely distorted. If, for example, employees would get 6 months or more of salary just for the profit sharing. So that was one of the reasons for having these structures in place. And many of them disappeared or are in the process of disappearing due to the reform because it prohibits the so-called subcontracting of personnel, which is defined as one individual or entity providing to or placing at the disposal of someone else the employees of the provider for the benefit of the recipient of the service. And it also prohibits providing employees to conduct the core activities of the recipient. So many of these structures included the provision of core activities. For example, in the case of a manufacturing business, perhaps the personnel company was the employer of the workers. And it was conducting precisely the main activity of the service recipient, which was to manufacture goods. So with these prohibitions, they needed to restructure how their labor arrangements. Something that is still permitted is the subcontracting of specialized services or specialized works, as the rules define these terms, provided that two things happen. One is that the service provider registers with a new registry called the REPSE and complies with certain obligations to provide information evidencing compliance with employee-related tax and labor obligations on a periodic basis. And the other one is that the specialized services are not included in the service recipient's corporate purpose or main economic activity. So for example, going back to my manufacturing analogy, the provision of workers to manufacture the goods would be prohibited, but hiring someone to perform janitorial services or to provide a cafeteria service would be permitted, subject to these requirements of registration with the REPSE and complying with those obligations, because those services would not form part of the core business of the company. With these rules came a new burden for the recipient of the services, because service recipients are also required to verify that the service provider is complying with its relevant employee-related labor and tax obligations. So the reform really creates obligations for both the provider and the recipient. To comply with the reform, in many cases, as I was saying, that restructurings were required, the employees of the personnel entity were transferred to the operating entity, becoming entitled to receive profit sharing based on the profits of the operating entity. Something else that is permitted under the reform is what's called shared services among related companies of the same group, who can provide among themselves back office services, HR, accounting, payroll, legal among the companies themselves, services of that nature. These are considered specialized services, and thus they are permitted if they comply with the two requirements I mentioned about registration with the REPSE and complying with the related obligations, and also that these services cannot form part of the main activity of the recipient. Now going to outsourcing companies and how they were affected. Similarly to the case of entities with dual company structures, multiple entities used to outsource various components of their labor force, frequently including the employees that performed their core activities, like the workers in the case of a manufacturing entity. These structures also had to be revisited because of the reform's prohibition of the subcontracting of personnel and the performance of core activities, resulting in the transfer of the employees that performed the core activities of the service recipient to the service beneficiary. And this also resulted in things like the following, which apply also to the scenario of when there's a company, when there are two companies of the same group, one providing services and the other one receiving them. So one of the things that had to happen was the registration of these companies with the REPSE as providers of specialized services, amending the corporate purpose provision of the bylaws of many companies so that the services to be provided would not form part of the corporate purpose of the service recipient, because if that were the case, then the provider would be providing a service, part of the core activity or corporate purpose of the recipient, which is now prohibited. Also revising the contracts between the service providers and the service recipients, making appropriate changes to comply with the reform, and also creating an internal infrastructure to ensure compliance with the new rules. So because there's a new set of obligations, both the service providers and the service recipients need to have some kind of mechanism in place, some kind of structure, a plan to ensure that the obligations are being complied on a periodic basis. With respect to profit sharing, on the positive side, it is now capped at 3 months of salary or the average profit sharing received by each employee during the preceding 3 years, whichever is more beneficial for the employee. It is still necessary to calculate the profit sharing as usual, based on 10% of the taxable earnings of the employer. But if the amounts to be distributed to each individual exceed the above caps, then the caps will apply. The potential consequences for not complying with the reform can be very significant, and they basically relate to 3 fronts, which are labor, tax, and potential criminal liability. On the labor front, essentially, we're talking about fines that can also apply in the tax front, and these can be as high as approximately $240,000. Perhaps one of the most significant consequences of not complying will be on the tax front, which is the non-deductibility of payments that the service recipient makes for the services received. So the service recipient might not be able to deduct those payments for income tax purposes. And also the service recipient might be unable to recover the value-added tax that it paid to the service provider. And also, of course, very serious, the potential for criminal liability for tax fraud when the hypotheses that can make this apply actually exist. So it is not something to be expected to happen on a daily basis, but this is an additional incentive to make sure that companies are compliant. Some issues that are still creating confusion are that some companies take the position that practically all services need to meet the requirements applicable to specialized service providers. For example, the REPSA registration and the providing of information on a periodic basis and ensuring that the provider is compliant. And then the REPSA guidelines that were issued after the changes to these laws that I've mentioned, they exacerbated the confusion, adding to the statutory requirements. They basically say that if someone has an employee providing services at somebody else's facilities permanently, periodically, or periodically, that by and of itself can create a specialized service situation where registration with the REPSA is required and also compliance with all the other obligations. And characterizing something as specialist services is not something to be taken lightly when it's not really, it doesn't have the nature of a specialized service, because it can result in joint liability for the service recipient if the service provider doesn't meet its labor and tax obligations with respect to its employees that are providing the services to the service recipient. So many companies think that an easy way out is simply to request all their services providers to register with the REPSA and to enter into specialized services agreements with them. But that is not necessarily a good solution, because there are some services that by their nature are not subject to the labor reform, are not specialized services. And by characterizing them as such, again, they are just buying for themselves the potential for joint liability. Another thing that happens that we've seen with our clients is that there's a service provider or a service recipient that is not a resident of Mexico. And because the law doesn't make any distinction, some people can conclude that even if there's a non-resident of Mexico, that company is subject to these new rules. In our opinion, that is not the case, because the rules were designed having residents of Mexico in mind. And lastly, if the proper analysis is not performed, the conclusion might be that some companies may no longer do business in Mexico, or that it's necessary to radically change their business model. We are right now helping some large clients with situations like this, where they resist changing their business model in a way that is unacceptable to them. They're facing some pressures from their clients, and we are helping them navigating this to hopefully get them to reach a satisfactory agreement. So thank you very much. And if you have questions, as Ralph indicated, please use the chat. Thank you.
Hugo, thank you very much for a great presentation on a subject that I know has been around for years and years and years, because I remember when one of your attorneys, who's now retired, John McLeese, used to talk about this as a great advantage for companies. And obviously, a lot of people took advantage of it at that time. But again, if anybody has any particular questions for Hugo, he has his email address on the presentation, which you will be receiving. On the legal side, you probably saw in the invitation and the registration materials name of Margarita Escalante with the law firm of Barnes and Thornburg. Margarita was going to talk about legal actions and activities which could take place were the Constitution of Mexico to be changed in the area of energy reform, something which President Lopez Obrador has been pushing quite a bit. However, that became moot last Monday when the Chamber of Deputies voted 275 for, but 223 against constitutional reform. and that was less than a 2/3 that was required. So that's sort of a moot point right now. However, the very next day, the legislation was introduced, a new mining bill having to do with mining exploration and removal of lithium deposits. And that could be an issue coming up in the future, particularly the importance of lithium to the lithium battery industry, which is going to become very big in Mexico. So Margarita said that she would take that up at the 2-session meeting we're going to have on the USMCA in July. So at any rate, now I'd like to turn it over to Edgar Lopez Lena. Edgar, it's all yours right now. You're on mute. I'm sorry.
Sorry about that. I guess
That's okay.
that's the phrase of the year, right? You're on mute. Apologize for that. So thank you, Ralph. I just need to have control. Share screen. Here we go. Okay.
You got control?
Thank you.
All right.
And you should be looking at my presentation. Hold on. Sorry about that. Let's. Okay, you should be looking at my screen, my presentation.
There we go. Yep.
All right. Okay. Well, after that very interesting and relevant update that Hugo gave us on the outsourcing rules, let's look at some other changes that the 2022 tax reform brought to us taxpayers. We are obviously not going to go through the entire presentation, the entire reform, because that would be a 4-hour or a week's worth of webinars, each probably going 8 hours. So we obviously don't want to get into that. We're going to really on some of the topics that we feel have resonate more and have a more impact on U.S. companies that have a footprint in Mexico. So we're going to go with a brief summary. We're going to look at transfer pricing for maquiladoras, other transfer pricing requirements, tax residency rules, the return of the mandatory audit for tax purposes, and the strengthening of the business purpose doctrine. And finally, we're going to close with a few other changes that are not by any means less relevant. So the 2022 tax reform had a lot of back and forth, as is usually the case with tax reform in every single tax jurisdiction that I know of. Mexico is certainly not the exception. The US, as we all know, is certainly not the exception either. But it finally passed in November and was finally enacted and published on November 12, 2021. Most of the provisions are applicable for tax years beginning on or after January 1, 2022. And a considerable number, if not most of them, of the provisions are focused at combating the understatement of taxes and tax evasion through the increase in disclosure and reporting requirements, as well as the strengthening of the business purpose doctrine. And we'll go through what exactly that means. Let's start with transfer pricing for maquiladoras. I know whenever we are in a conversation or whenever we're in a presentation like this, and I'm guessing this would not be the exception, whenever we speak the term maquiladoras, people start opening their eyes and really perking themselves, because we know that a considerable number of the companies represented here and our client base, of course, many of them have maquiladoras operating in Mexico. So what's going on in this realm? The repeal of the option to apply for an advanced pricing agreement to determine the maquiladoras transfer pricing policies is repealed. So starting in fiscal year 2021, maquiladoras have only the option, or it's no longer an option, it's the only methodology available is the safe harbor methodology to calculate the prices that they have to charge to their U.S. principal for the performance of the assembly or maquila services. There's no grandfather rule. There's a disguised, if you will, transition provision that allows maquiladoras that have an advanced pricing agreement in force and approved by the SAT, the SAT, the Mexican taxing authorities, they can continue applying it or using it for the duration of the agreement, which is usually 5 years. But at the end of the term of the 5-year term, they must automatically revert to the safe harbor method. They cannot apply for an extension of their advanced pricing agreement. New maquiladoras that are set up new after January 1st, 2022, they have no option but to use the safe harbor method. Their repeal applies to both shelter operations, which is when a U.S. company hires a third party to perform manufacturing activities, or it also applies for self-owned maquiladoras, namely U.S. companies that own a Mexican legal entity that operates as its own maquiladoras. This repeal affects both types of arrangements. It's not necessarily all bad because the safe harbor has its advantages. Namely, it's a more simple approach. The compliance is much more easy. It's much more straightforward because it's a formulaic process. It's part of preparing the tax return. The same method can be used, or has to be used actually, year after year. And in terms of cost, it's really the cost of paying a tax professional to prepare the calculation. The advanced pricing agreement, on the other hand, requires developing a transfer pricing methodology, sitting across the table from government officials, and just like in any other negotiation, there's a lot of back and forth. The taxpayer can and its advisors can propose a tax methodology. The government officials obviously come back with an alternative. So it becomes something that can lag even up to a year in negotiations. It requires annual updates and a full reassessment every 5 years. And obviously, in terms of cost, the taxpayer has to hire tax advisors, transfer pricing advisors, and it must also pay government fees of approximately $13,000 for the initial application and an extra $3,000 for the annual review of the advanced pricing agreement with the officials. So it does have its advantages, but in most cases, the safe harbor will result in a higher tax liability for the maquiladora compared to using the advanced pricing agreement approach. And something of note, something that we've been asked a lot, is whether other types of arrangements, other types of transactions can still apply for an advanced pricing agreement. And the answer is yes. This repeal of the pursuit of an advanced pricing agreement applies only for maquiladoras. If we have a fully full manufacturer, if we have a distribution operation, that taxpayer can still apply for an advanced pricing agreement with the government. And later on, we'll see why this is relevant. In the wake of the repeal of the advanced pricing agreement option, as I was saying before, and this is something that we've seen in reality, in actuality, some owners of maquiladoras may see their Mexican income tax liability increased to, sometimes up to 100% of the tax that they had been historically paying with the advanced pricing agreement. So one question that we've been asked and that we have asked when we encounter this is, maybe it's time to migrate from the maquiladora arrangement to different arrangement. Maquiladora is the most commonly used manufacturing arrangement in Mexico, but it's not for everybody. There are other alternatives. And with this repeal of the advanced pricing agreement option, it may be time to ask ourselves, when we are happy hour after the office or having coffee in the morning, is it worth switching to a different manufacturing arrangement? Other transfer pricing related changes are now the Mexican income tax law clearly specifies that transfer pricing requirements apply both for enterprise and individual taxpayers. So if I am a US person that owns a house in Los Cabos and I want to rent it to my cousin, I need to meet transfer pricing requirements. Just as a manufacturer that is performing complex manufacturing for a foreign related party. There are additional scrutiny mechanisms. So now transfer pricing does not limit only to the prices used in intercompany transactions, but also on the profit that the taxpayer obtains on those transactions. Transfer pricing must now be pretty much, there has to be a transfer pricing analysis and a transfer pricing report, basically for each individual transaction that a taxpayer carries out, whether it's revenue generating or whether it's cost generating. This mechanical rule will have a considerable impact in transfer pricing, because historically, when testing a transaction, or when benchmarking a transaction, the law allowed taxpayers to use the weighted average of information for the current year and the prior 2 years. Now the rules state that only the year under review can be used. So that's going to create all sorts of distortions in the profitability of transactions. And obviously, we have to see how the current situations like crisis in supply chain management, even the unfortunate events that are developing in Eastern Asia, how they're going to affect this as well. The 6 traditional pricing methods remain, but when times come to actually make adjustments to transfer pricing, to the transfer prices, the taxpayers can only support those adjustments with either the interquartile method, a method approved by the SAT and the IRS through a mutual agreement procedure, or a method approved by the SAT in an advanced pricing agreement. So this is why the fact that other non-maquiladora operations can still apply for an advanced pricing agreement becomes relevant. Because again, maybe it's time to think about pursuing an advanced pricing agreement. It was a very rare occurrence when a non-maquiladora taxpayer applied for an advanced pricing agreement up until 2021. But with the advent of these new rules and complex and detailed scrutiny and support that now the rules require, it may not be a bad idea to think about sitting down with authorities and negotiate and compromise on both sides of the table and reach a mutual agreement as to how a transaction should be priced. I'm not going to go through this table. You will see it in the materials that will be uploaded in our website of the chamber. But there were some changes to the multiple transfer pricing related filings that a Mexican taxpayer has to do every year. For 2022, there were changes. Some of the filings were actually the dates were pulled, meaning that filings that used to be done by December of the next year now have to be done by May and July. So that's great news. So obviously we need to be aware of those deadlines. Tax residency, some important changes that affect both individuals and enterprises that move around, that are mobile, which obviously in this day and age is a very common occurrence. But basically, of relevance in terms of individuals, is that a Mexican national will be deemed a resident of Mexico until they prove otherwise. And the importance here is that a Mexican resident individual is subject to their worldwide income, subject to Mexican taxation in their worldwide income. So a taxpayer that abandons Mexico with the sole purpose of obtaining a tax benefit will still be considered a Mexican tax resident, even if they live in another country. So we have an individual that lives in Mexico and they feel or they think that because they migrate to the US, for example, or to any other country, and that's the only driver for that change is that they are going to pay less taxes, Mexico is going to still treat them as tax residents. Those companies that are bringing employees from Mexico for secondments need to make sure that they have documentation to prove that the move is derived from a personal decision or an economic decision and not a tax-driven decision. How do you accomplish that? By making sure that there's an employment contract or a job offer in another country, that there are secondment contracts, investment plans in a foreign country, or letters of intent or confidential memoranda for joint ventures with foreign enterprises. Maintaining tax residency in Mexico, this is the worst case scenario, while living in another country may lead to a true and undesirable double taxation. So if we have a non-compliant individual that moves into the US, they may actually looking at paying close to 50% of taxes combined. So this is something that it's not to be taken lightly. There's a filing that needs to be done now in order to notify to the SAT that there's an abandonment of individual tax residency. That's also important. Something similar occurs to legal entities that expatriate to another country without a true business reason will be considered tax residents of Mexico, even if they move to another country. So they can also be facing a very, very bad situation of actually paying double taxes in both tax jurisdictions. Entities and individuals that migrate to a jurisdiction with a low tax rate may also still be considered tax residents of Mexico. So again, moving into another country, there's a lot of homework to be done from the tax point of view for both individuals and enterprises. The return of the mandatory audit for tax purposes. This is something that has been back and forth in the Mexican tax law for a number of years. The mandatory audit for tax purposes basically is an audit performed by an independent CPA that requires that CPA to do an examination of the financial statements, like any traditional audit, but also to audit the tax return and the tax postures that taxpayer obtained and filed during the calendar year. It's a bit of a unique scope that doesn't exist in the US. An independent auditor in the US usually does not audit the tax return of its client, of his or her client, but in Mexico it actually happens. And it's in some cases mandatory. So this is the history. Until 2013, the tax audit was mandatory for taxpayers that met any of these gross receipts and fixed asset thresholds. Then from 2014 to 2021 became optional, strictly optional. It was entirely an election for certain taxpayers. And then from 2021 on, it now becomes again mandatory. And the main driver to become obligated is if the Mexican company or the taxpayer shows 1.6 billion pesos, which is give or take $80 million of gross receipts in its tax return. So those companies, the message here is let's pay attention of the revenue that Mexican company is obtaining, because it may fall under the requirement to have an audit by an independent CPA for the tax year ending December 31st, 2021. Strengthening of the business purpose. The Mexican system has been primarily focused on form over substance. In an audit, usually an agent would pay, used to be a case where they pay more attention to the actual document than to the transaction behind the document. As long as the document looked okay or robust, usually that would end the scrutiny of that transaction. But that has changed over time, obviously. So now there's equal weight to the document than to the actual transaction behind that document. So we'll see some instances where this is relevant. But basically, the business purpose doctrine states that the competent tax authorities may recharacterize as a transaction if, in the opinion of the agents, the economic benefits obtained in that transaction are lower than the tax benefits obtained, or if in a step transaction, the transaction could have been accomplished in fewer steps, and the tax liability resulting from those fewer steps would have been higher. So if an agent is auditing a transaction and they feel that it doesn't meet either one of these requirements, they could disallow the tax benefits of that transaction or recharacterize it as something else, regardless of what documentation is in place, of course. So what are some of the provisions of this doctrine for 2022? Negation of change in tax residency, as we saw before. If an individual or a Mexican individual or Mexican company expatriate to another country with the sole purpose or lacking a true business purpose, then the Mexican taxing authorities can recharacterize or negate the abandonment of the tax residency. Tax-exempt mergers and divestitures will become taxable if the transaction lacks a business purpose. Requests for a tax deferral corporate organization will also be denied referral treatment if the transaction lacks a business purpose. Negation of tax write-off of assets. If a company writes off an asset and there's really no business purpose behind it, then the SAT may disallow the tax benefit of the write-off. Loans made to Mexican legal entities can also be considered back-to-back loans. That is a bad situation if that loan doesn't pursue a true business purpose. The main consequence of having a back-to-back loan is that the interest that the Mexican taxpayer pays on that loan will be recharacterized as a dividend and not as interest, as an interest. Other changes are that digital images, i.e. NFTs, are considered intellectual property. So when a Mexican taxpayer buys NFTs from a foreign seller, there is a withholding tax in place of 10% if that individual is, or that seller is a resident of a country with which Mexico has a tax treaty. Individuals of 18 years or older are required to obtain a tax ID, even if they earn no income. So you need to be aware of that. Beneficial controller disclosure requirements. Now the government requires that a Mexican taxpayer discloses the identity of the ultimate beneficial controller. So it's not enough to disclose who owns a Mexican legal entity or who is the beneficial or the recipient of income in a transaction. Now the government requires that the ultimate owners of a Mexican legal entity be informed. So let's say that we have a multi-layer structure in which a group of U.S. individuals, for example, own several U.S. LLCs and indirectly own an underlying Mexican legal entity. Well, now the Mexican legal entity is required to report to the SAT the identity of those individuals, even if they are way up the chain of ownership. There's a new trusted taxpayer regime for certain individuals. There's a new cash basis regime for small co-ops with gross receipts of 30 million pesos or less. And there are limitations on the recoverability of value-added tax if certain non-value-added tax transactions are carried out. This affects some companies, for example, that a Mexican taxpayer that sells a product that is shipped from the US into the UK, for example. That is a transaction not subject to Mexican value-added tax, and that can limit the amount that that Mexican taxpayer can recover out of the value-added tax that it pays to local vendors and suppliers of goods and services. So with that, I'm happy to answer any questions. My email and direct number are at the beginning of the presentation, and of course, you can see it in the once the presentation is uploaded. So I guess I'll turn it back to you, Ralph, and thanks for
Edgar, a quick question from Eileen Turcott. Is it easy to convert from maquiladora to a different manufacturing arrangement?
The answer is no. It's not that easy. There's not only tax consequences. Maquiladora is not a check the box election where you just file an election with the SAT and then your taxes are maquiladora. It's an entirely operational arrangement. So you would have to look at supply chain, logistics, ERP, taxes, obviously, even commercial relationships. So it's not an easy process, unfortunately.
Edgar, thank you very much for a complete presentation. If you could get out of your share screen so Myra can get on.
Go.
All right, looks like I'm on. Hello, everyone, and thank you for joining us. My name is Myra Pena. I'm a senior director in the International Tax Services Group and a member of the Mexico Tax Desk at RSM in Chicago. Today, I'm having trouble moving there we go. All right, so today I'm going to review recent developments in US tax law, as well as proposed changes by the Biden administration via the Green Book proposal that have an impact on multinational companies. So in January of this year, the Treasury and the IRS released final regulations that changed the definition of what a creditable tax is. So by way of background, in the US, a taxpayer is allowed to take a credit for income taxes incurred outside of the US. This is known as taking a foreign tax credit against the income tax liability of a US company. Before these changes were enacted, the definition of a creditable tax did not include the requirement for the tax in question to be levied on income with nexus or connection to the taxing jurisdiction. This is the historical definition that we were working with was essentially that the creditable tax needed to be based on a requirement that the tax be based on income. So for example, any tax that was based on property, for example, or a property tax would not have been creditable for US income tax purposes before these new regulations. So in the context of nexus refers to the link between the taxing jurisdiction and the activities of the taxpayer, the source of the income, and any property within that taxing jurisdiction. These regulations were initially proposed in 2020, and at the time, commentators had raised concerns regarding the appropriateness of requiring a jurisdictional nexus or connection to the taxpayer's activities or investments. However, regardless of these objections, Treasury retained the proposed jurisdictional nexus requirement. However, it rebranded it as the attribution requirement in the final regulations. These new regulations also impose a more stringent burden of proof on taxpayers for foreign taxes that are imposed in lieu of an income tax. The basic rule remains the same in that the tax must be in substitution of an income tax. However, the substitution requirement has been expanded to a 4-part test in order for the tax to be considered creditable for US income tax purposes. The first of the 4-part test is that the foreign country must actually have an income tax. The second is that the tax in lieu of the income tax must not be duplicative. Excuse me, I've forwarded too fast. The third test is that the taxpayer must actually show that the foreign tax, that the tax in lieu of the income tax is actually applied to a specific type of income or activity of the taxpayer. And the fourth and the last test is that it must satisfy the attribution requirement that we've been discussing. So the jurisdictional or the nexus requirement is similar to what we would review in terms of identifying where in the states we might actually have a filing requirement. So for example, we would review what activities the taxpayer has in a given state. We would look at the source of the income, and we would consider any property that's located in that particular state before we can determine whether or not that stream of income is actually taxable in that state. The attribution requirement is really meant to limit the creditability of foreign taxes levied on digital services, as well as other withholding taxes. So for example, these new regulations would limit foreign tax credits for withholding taxes that are imposed on payments for services performed outside of that given taxing jurisdiction, as well as withholding taxes imposed on royalties for intangible property used outside of the taxing jurisdiction. So as you can imagine, in today's global and digital economy, these new rules will have a significant impact on US multinational companies. The jurisdictional nexus rule is effective for tax years beginning on or after December 28th, 2021. So we're obviously in prime time for these regulations. It is incumbent for companies to review their income streams to mitigate the potential for double taxation of foreign income as a result of these new regulations. All right, and now moving on to the Green Book proposal and its alignment to the OECD Pillar 2 provisions. I warn you in advance, there are a lot of acronyms here. So if it's any consolation to you, the more you listen to these tax talks or read tax alerts, the more you will become familiar with these terms. And you may also be consider yourself an international tax expert. So to set the stage, the OECD is the Organization for Economic Cooperation and Development. It is an intergovernmental organization with 38 member states, the US being one of those member countries. The OECD has been working on a framework to address base erosion and profit shifting, and has arrived at a two-pillar solution. These pillars are referred to as Pillar 1 and Pillar 2. Pillar 1 essentially seeks to shift tax on large digital service providers into countries in which sales actually take place. Pillar 2, on the other hand, seeks to establish a minimum global tax rate. There are two components of Pillar 2. The first component is the Income Inclusion Rule, or IIR, which imposes a top-up tax on a parent entity when a member of the financial reporting group is subject to an effective tax rate below 15%. Implementation of the IIR rule is planned for 2023. The second component of Pillar 2 is the Undertaxed Profits Rule, or UTPR. This rule denies deductions to a member of a group with an effective tax rate below 15%. And in the case where UTPR would apply, that member would not also be subject to the IIR rule. The implementation of Component 2 of Pillar 2 is planned for 2024. The Green Book proposal also repeals, the Green Book proposal would repeal the Base Erosion and Anti-Abuse Tax, otherwise known as BEAT, with an under tax profits rule, which is similar to the Pillar 2 provision. The UTPR essentially would target foreign parented multinationals operating in low tax jurisdictions. On the other hand, the Build Back Better Act would have retained BEAT with several modifications. The Green Book UTPR would apply to financial reporting groups with 850 million annual reporting revenue in at least 2 of the last 4 years, with certain de minimis exclusions. Now, similar to the OECD UTPR rule, the Green Book proposed rule would deny deductions to group members with an effective tax rate lower than 15%, and would not apply to income that's already subject to the IIR rule or subject to the GILTI rules. And speaking of GILTI, the Green Book assumes the Build Back Better Act as a baseline. However, it reduces the Section 250 deduction from what it is today at 50% to 28.5%, which would result in GILTI income being taxed at 20% instead of the current effective tax rate of 10.5%. Now, as part of the proposed rules, the reporting under Section 6038 would be expanded. In general, Section 6038 requires information reporting with respect to certain corporations or partnerships in certain foreign financial accounts. The Green Book proposal also includes additional reporting obligations for taxable business units of multinational companies. What does this mean? The proposal would shift to applying the GILTI Subpart F and foreign tax credit provisions on a jurisdiction by jurisdiction basis. These rules would be effective for tax years beginning after December 31st, 2022. The Green Book proposal would require additional reporting for foreign financial institutions. For example, it would require account balances for financial accounts held by a foreign person and maintained in the US by a financial manager. It would also expand current reporting required with respect to US source income paid to accounts held by a foreign person. It obviously goes without saying that the Green Book proposal, similar to the Build Back Better Act, is only a proposal, and it would take a lot for the proposed rules to actually become law. So that pretty much covers my review of these recent developments in the international tax space. Ralph, I think I will now hand it over to Angel. So if you would move the ball, that would be helpful.
Okay, if you just get out of your screen share, we can get Angel on board. And Myra, thank you very good for an excellent presentation. As I remember, and this is probably a little bit before your time, it was all the studies that the OECD did on transfer pricing that caused the Mexican government to adopt some of those activities for its transfer pricing. That was quite a while ago. Thank you, Myra.
Thank you, Rob.
Angel, we're going to a slightly different topic, but one that's very important to people with operations, and that is the subject of supply chain. Angel, it's all yours.
Thanks, Ralph. Hope everyone is seeing my screen.
Yep.
Perfect. Okay, I'll try to go as fast as I can. We know a little bit close to be on time, and we still have a presentation to go. I'm Angel Ramirez. I'm the Senior Manager in the Supply Chain, International Practice and Business Development in Baker Tilly. I have 7 years of experience in supply chain, actually been in production controlling in several plants in injection molding in the automotive and plastics industry. And I was a former trade commissioner of Mexico for Detroit, covering Michigan, Indiana, Kentucky, and south of Illinois for 6 years during the past Mexico administration, and since then I've been in Baker Tilly, talking a little bit about my experience in supply chain. And well, talking about what has happened, we all know that even prior to COVID-19, the trade dispute that started in the previous administration here in the US in between China and the US, it kind of starts shifting the minds of what should we do to the supply chain is not business as usual. And then of course the pandemic hit, causing a big disruption, and basically everyone was impacted, from empty plant floors because of a lack of one component or a lack of many components. Anyway, we all experience these disruptions either personally in our day-to-day business or with clients or when you go to the shelves. I remember the first month of the pandemic, trying to get things as cereal. I still have very vivid in my mind going to try to get a box of cereal and the entire aisle of cereals completely empty. So we all experience now in firsthand what a supply chain disruption means in the day-to-day lives. Let me move to the next slide, Aries. Well, believe it or not, there were some winners and there were people and industries that were possibly impacted by the industry, since increased demand up to 71%, to get your products into market, but these were the exceptions. Those companies were mostly, life science sectors or products that never thought that would see an increase in supply chain, I don't know, like plexiglass or polycarbonate, for example. But other than that, most of the other industries were very hit, and specifically manufacturing and distribution. What impacts did they have? Negative impacts mostly. Like we mentioned before, supply shortages, increased prices in their components and raw materials, fulfillment delays, transportation prices. We can speak all day about it. I remember back when I was in the industry, your usual container from Asia to the Americas, $4,000 or $5,000. Nowadays, it's 3 times the cost and just going up. Economic impacts, reputational impact, that's very important. And nowadays in the e-commerce world, being on time is everything. And now getting an order and basically wait forever to be fulfilled, that was another big impact for the manufacturers. Third most important impacted sector overall. Of course, the other one's nonprofit education. Mostly the impact was because of the lack of personnel, not able to go to work physically. And of course, healthcare, we all know what happened, same as that. But anyway, basically all sectors were impacted. Trying to go a little quick. How big was the impact? Among the people that we have surveyed, significantly, it was a significant impact. Most companies plan to do something, to try to improve their supply chains resilience, combining what they could, like increase inventories, raw materials to diversify supply chains. But of course, during the pandemic, it was very different. They're difficult, if not impossible. So moving forward, and like I said in the beginning of my presentation, because of the dependency of the supply chain in Asia Pacific and the trade agreements and the pandemic, there has to be more efforts to have a regional network. And that this is something not new. It's something that other regions of the world have done. The clear example is Europe with West Europe. They, don't get me wrong, they also have supply chain dependencies at some point in Asia Pacific, but not as big as North America. Moving to my next slide. Okay, what impacts the supply chain? Like I mentioned, geopolitical, social, economic risks, and disruption-based issues, like the pandemic. Those things you cannot control. The other ones can be controlled and should be a part of what you should do to become from being a reactive to these supply chain issues to being anticipatory when in all means possible, of course, to the supply chain issues. These are what you can control. And I'm going to talk a little bit more in detail in the next slides. Rapid for sharing processing planning. What do we mean by that? It's trying to integrate your supply chain and enterprise strategy. Investigate alternative business models. That's very important. Closer locations to create capacity, reduce risks, or create sourcing synergies. Identify economic and strategic benefits or downsides when you make those changes. Because as beautiful as it sounds, it's like, yeah, we're just going to move our whole supply chains close to home. You have to take lots of things into consideration. Cost, of course, is one of the most important, but many things go into that detail. But now, most important than ever, geographic diversification is very important. This coronavirus crisis is the latest proof that we have to reduce the dependency on China as a major sourcing location. Sales and operations planning, that's another thing that you have to consider. It's an important time for all manufacturers to be agile and react to these changes and plan production differently. Conduct business continuity risk assessments as well. Companies cannot predict, of course, when a public health crisis is going to happen again, but you can help to mitigate the effects of unexpected disruptions based on this experience. And even you review your insurance coverage, for we all, well, not, probably we all heard, but all those that are close to the auto industry, the shipping bringing lots of cars coming to the US that finally was going to get some back orders, and well, long story short, the ship caught on fire. So those things should also be considered differently nowadays. Well, this is your typical offshoring disruptions. This is what you're always going to face when you're supplying and getting supplies outside of your country where you're selling from. Like I mentioned, natural disasters, economic, geopolitical impacts, cultural barriers and differences, proximity only times, quality control and IP concerns. And all of these are part of your supply, overall health of your supply chain. Every supply chain is not going to be 100% proof, but normally the farther you have it, the more risk exposed you are. And of course, the traditional supply chain risk factor will be, 5-10% normally pre-COVID. Those numbers were blown up during the pandemic. And this supply chain resiliency was drastically impacted through COVID, making us have to take a look again to see what can be moved and what shouldn't be moved. Would this bring us to nearshoring? Nearshoring is not a new concept, but of course it's been taking a lot of importance since the pandemic. In the survey that we made with clients, 64% of manufacturers are extremely likely to reshore nowadays. And the main reason, like I said, the economic sanctions that were put into many of them in the previous administration here in the US, and of course, the pandemic. What those nearshoring means refers to an organization's transfer of certain business operations, in particular its own manufacturing capability or key suppliers to a nearby country closer to the demand location for its manufacturing products. For US companies, not nearshoring may mean moving a supplier from China to the US or neighboring countries, like I mentioned my example of Europe with Eastern Europe before that, meaning Mexico or Canada, that are the US two largest trading partners. However, this not necessarily is a very easy decision because of many reasons. In some cases, China, and not only China, another Asian country will not make that decision easy to nearshore because many products require substantial transformation and value-added labor. And because of so many years that Asia Pacific and China has been doing it for so long, this gives them an advantage because some of the entire processes are already only done in that part of the world. I'll set an example. We had a client that it's into bath fittings, your shower faucets and your everything you see chrome in the kitchen as well. those processes migrated from the entire American country, most of them not right now, 20, 30 years ago. So for the last decades, companies worldwide have been relying on that supply chain and disappear in the local suppliers that either they have to close doors or they went to a different applications like automotive. So now that this company is trying to source many of those products back, either there's no other company or supplier in North America that can tackle that specific finish or product because the expertise is not there anymore, or it will take years to make that expertise back again. And even if you bring it back, you have to consider the cost. So in a world that every product we buy has many components, you really have to analyze component by components to see what you can bring. And like I mentioned, in some cases, because of the vertical integration that has happened in Asia Pacific and China, some things you cannot bring back, but others you can. And of course, there's always alternative to do this. The things that you cannot bring back. Before the pandemic, the management of inventory was way different. Just in time was really just in time. Now we all have to reconsider that, and in those cases, change inventories or do sub-assemblies or have finishes in Asia Pacific and try to control and have the more complete finish in the US or closer to your market. Moving on, sourcing and supply chain planning. We have basically three different levels of how we react. The very reactive one, that's what happened during the pandemic. Few companies had a moderate responsive way to approach the pandemic, but now we have to move to a high anticipatory planning. It's no exception. The supply chain pre-pandemic was starting to move more to a digital transformation, but now with the pandemic, this is going even faster. What I mean with digital transformation in the supply chain is the race to not only to enable the automation of your supply chain, example like robots in the warehouses have been able to work 24/7 with no lights and everything that has been there before, but it's not necessarily a solution. What we mean is by companies need to utilize digital technologies not only to create like I said, a digitized autonomous supply chain, but it also needs to connect supply chain technologies across platforms to plan and make a better procurement, manufacturing, and logistics that work beyond the organization's four walls. Is the difference between doing digital or being digital. We can think about autonomous operations in terms of like I said, hands-free, self-driving, but technology, what I mean by use AI technologies across the end-to-end supply chains to make predictive decisions. What happens when we lost the supplier here, and there, and make the algorithm and make the predictions on where to have the backups to avoid a situation like that with the pandemic happen again. Ultimately, digital and autonomous technologies will help make people's job easy and make the supply chain a little bit more robust and optimized. Nearshoring considerations, like I said, is not as simple as that. You have to consider what's going to pick your poison, to put it in that way. Intensity, labor versus automation, logistics versus labor infrastructure. When you have to consider the challenges like freight insurance and cost, lead times, labor costs, labor availability, stability and tariff regime and trade relations. We had the example when we here in North America, we went from the change to NAFTA to USMCA. We were used to stability for 20 years and we planned on that stability to never go away. Then during the negotiation, of course, we saw that traditional back and forth between the countries to make negotiations, but that impacted the traditional supply chain. And unlike we mentioned before, if it happens to align with the pandemic, it's even worse. So those things you also have to consider that can change as well. There's many companies have similar suppliers in China that you can nearshore country. And you also have to consider that even though you might not have the specific capability right now in the Americas, because A, it was never here, or B, it has migrated, we also have to follow what the China suppliers are doing, because some of those might migrate on their own. Of course, not immediately, but if the China suppliers that are vertically integrated and dominate that product will move closer to your supply chain, you can also have to consider. Investigate alternatives, that's another thing. If you cannot find some specific product, there might be another material, another resin, another metal that you can get locally. And of course, also complying with the rules like the steel rules that we all know that pre-trade wars, to put it that way, and pre-pandemic, you can use steel from anywhere. Now you have to use local steel. That's just an example. And after all, you have all of this investigation and getting your software and getting your teams. One important thing is that pre-pandemic and pre-everything, your supply chain was normally driven basically by your supply chain panel, your supply teams in your planning, your organization. Nowadays, you have to consider everyone. You have to consider your engineers, your accounting department, your financials, because it's affected in all levels, and you have to do that. And that's what I mean with a battle drill. Battle drill is basically make the assumptions. What will happen if this and this and this and that happen? What will happen if this or this doesn't happen? And if you can make it on your own, great, but if not, we'll highly suggest that you can typically require a company to seek outside assistance to make those smart decisions, to make those scenarios for you. Thank you very much. I try to be a little quick because of respect time. We're almost up to the hour and we still have one presentation to go. But if any company decides to keep its existing source suppliers or not to reshore, that could be also an option. But the message I want to give to all of you is that you have to understand the vulnerabilities of your supply chains better than ever. And thank you very much. We're here to help. And Ralph, I'll turn it back to you so we can move to the next presentation.
Okay, if you can get out of your sharing. Adhel, that was an excellent presentation. I'm glad you covered nearshoring, because as nifty as it sounds, it's not always easily done or quickly done. And if you want to participate in the USMCA and bring product from Mexico into the United States that has some Chinese contents, you have regional value content that you have to look at. And in some cases, if the components are critical and they're only being made in China, you might not be able to meet the regional value content in Mexico. So
that's right.
A good point. There's a lot of things that have to be considered, and it's not as easy as you think. Our last speaker, Omar Garcia. No, it isn't Hugo Dubovoy. Omar got Hugo's invitation by mistake, but he is on board from our new member, Mazars USA. And Omar is going to talk to us a little bit about the fiscal view and economics and where we're going from here. So, Omar, take it over.
Thank you, Ralph. Sorry, I will also share my presentation with my colleague, Rene Severac. He will start with the Mexican economic aspect. And thank you for all the panelists for go over all these important changes. So, Renaud, you can take it over.
Go ahead, Renaud. It's all yours.
Thank you, Ralph. Thank you, Omar. Hello, everybody. Renaud Severac, Senior Manager in Mazars in Chicago, mainly working on audit for international listed company. And I was working with Omar in Mexico during the past 3 years. So let's start with the macroeconomic presentation, let's say the gross domestic product. Mexico's economy picks up at a start of 2022. So we can see there the history, and the object of the discussion is mainly to speak about the coming evolution and coming change in 21 and 22, mainly 22, and after we have a quick overview for the 23 budget. So revised estimates indicate that Mexico GDP grew an annualized 0.1% in fourth quarter 21, after falling 2.8% in the third quarter. So as a result, GDP grew 1.1% in 21. Furthermore, Mexico's global economic activity index, the monthly proxy for GDP growth, shows a pickup in activity during the first 2 months of 22. So the consensus forecast for 22 is mainly remained 2.6% in February, and the latest data we can see on different source for the economic and finance investors are showing that the industrial production, the retail sales and employment grew, while exports typed down. The peso held steady in February against the dollar, but inflation is remaining elevated in Mexico. So we note also that new COVID-19 cases in Mexico continue to decline, nearing pre-Omicron levels, and the vaccination rate rose further and now encompasses 62% of the population. So this is a very good news for Mexico and for the coming months. If we speak quickly of the economic activity improves, year-over-year growth in the global economic activity index improved from 1.6% in January and 2.8% in February. So service-related activities, including trade and transportation, for example, grew 1.6% in February from year levels after expanding 0.5% in January. So good producing industries increased 3.5% globally. So if we now speak about the industrial production expense for Mexico, which includes manufacturing, constructions, oil and gas extraction, utilities, we note an improvement between January and December 21. On a month-over-month and on smooth basis, the industrial production was up 1% in January, while manufacturing was up 0.3%, and north of the border, US industrial production increased 1.5%. So we can see that the correlation between industrial production in Mexico and the US increased considerably with the rise of intra-industry trade between the two countries. And this is also the object of this webinar. So the exports declined slightly, mainly due to the context. We all know that the COVID has impacted strongly all the countries and their production. So there is no surprise on that side, unfortunately. On the exchange rate, the peso holds steady against the dollar. The Mexican currency averaged 20.4, 20.3, 20.4 pesos per dollar in February, about the same as in January. So, however, the peso is down 7.8% from its pre-pandemic level in February 2020. The peso has been under pressure due to the persistent higher average inflation in Mexico than in the US, and more recently increased uncertainty regarding domestic and global growth. So perhaps, Omar, I can let you know.
Thank you, Renaud. Talking about the inflation that we have during 2021 is 7.35%. That it is higher in comparison with the other years. The lowest historical inflation that we have, we need to go back to 2015. that was 2.13%. So that is the lowest inflation that we have historically in Mexico. So the real right now inflation that we have until March is 2.43%. And the Mexican government, when they established the tax package last year, they estimate that we will finish 2022 with an inflation of 3.4%. The real inflation right now, up to March, is 2.43%. So we have many months to left, and the inflation is going to be higher than the government estimate. According with some economics information from the Bank of Mexico, maybe the inflation is going to be around the 3.5, 3.7%. So it's going to be more or less the information that the government estimated. So that will depend also in the macroeconomics topics that Mexico is also facing. But even though Mexico has a very strong macroeconomic policies, that even in COVID, Mexico have a strength in some areas that we will discuss further in this presentation. Moving on the interest rates. So right now the interest rate in Mexico is 6.73%. The estimated interest rate by the Mexican government is 5%. But right now, as the close of May, more or less, well, that we have right now in April, is 6.5%. So it's going to be established this interest rate. So we hopefully we have the same by the end of the year. Talking about the oil price, you know, Mexico, it is become less export oil products right now. So basically our exportation, we have it more in different other products than the oil that we was in the past. So basically right now, the average oil price as at the close of February is $52.63 per barrel. So our estimated by the government by the close of 22 is going to be $55 per barrel. So basically that estimation is going to be same, but obviously the oil price is changing by macroeconomic factors that maybe can be further go this price on the future. So we will see what happens in the next following months, depending on how the price can fluctuate. As I mentioned before, Mexico in last year has an increase on the exportation of products, not only on the oil exportation, but also in other products, specifically in the automobile exportation, that have an increase of $139 million. That means 13.8%. Even though this increase on the exportation, Mexicans have a deficit on the commercial balance between the importation and exportation. We have a deficit around 18.5%, but at least this is going to be a very good year talking about the exportation. And going forward, this exportation, specifically in some areas like automobile exportation, had this increase, and this value is a lot for Mexico, because we have established the USMCA. So what is one of the trigger that we have during these last years to increase this exportation? Okay, that is our presentation, Ralph. I came back to you to respect everybody's time.
Omar and Renaud, thank you very much. Excellent presentation. I mean, we need to be looking forward to the future to do our planning properly, and you certainly helped out. I have one question that I will ask, and it's a favorite question of one of our members of our North American Working Group. He is listening. So I think he's smiling right now that I'm going to address this, but your clients, all of you, count on you for being their early warning system when it comes to new rules and changing rules. Do you get sufficient lead time on changes from your contacts within the Mexican government on things that involve your clientele? If you don't, what suggestions might you have to improve the process so you're learning things a little bit quicker and get them to your clients quicker? As we know that when rules and regulations are promulgated, they sometimes take a long time to get down the chain to the clients and get them cooperating and doing what they need to do to fulfill those rules and regulations. So do you think you got a good enough early warning system, or would you like to see it better? What are your suggestions?
Well,
Well.
if I may start, I guess everything is subject to improvement, right? Anything, any process that you have in place. So yeah, I guess we, in our experience, we do have a good rapport with agents at the SAT and the taxing authorities in Mexico. I guess the one thing that everybody could benefit from, I guess, the taxpayers, the government, and the profession, or the tax advisory profession, is a little bit more definition or about what to expect with the changes. I know it's difficult. As you said, there are many different postures, different heads don't always think alike. So it's not easy to reconcile ways of seeing things or points of view. But sometimes when we go to our clients and explain what to expect, I wish, or we wish, we could give them a little bit more certainty about these changes. And the reality is that we cannot say, well, this is more likely than not to pass, because we don't really know. And there's nothing worse in life than uncertainty. So if we could get a little bit more certainty with a little bit more leeway, I think that would help the whole process. It would help companies react to the changes. It would help the government to adapt to those changes, and it would help us also to adapt to the proposed changes that are coming.
What about the form versus substance? I know you talked about that before. On some of these changes, are you just getting sort of the form, but not all the details that you need to pass along to your clients?
True, yeah. And the more things go into the substance, the more facts and circumstances things become, right? When there's a lot of emphasis on the form, it's a little bit more black and white, or there are less shades of gray. When you move into a substance situation, the shades of gray multiply. And that's how it is. We completely understand. But as you said, yeah, we could have a little bit more definition as to what to expect in the substance realm. That would also help us.
Any comments from anybody else?
Yeah, Ralph, if I allow me, besides other comments, I think it's very important that even though we have some warning from the government about the changes, we need to also have, besides the certainly, the backup information from the government. For example, the Carta Porte that has been moved forward, the enacted to be by the taxpayer. So we need to have more information, because at the end of the day, it's going to be affected everyone.
Yep.
And we need to have that certain in place, and also have the correct format to present that information to the government. So I think that is one of the drivers that we need to have, obviously, to everybody understand what will be the position from the tax authorities.
Okay, anybody else?
Ralph, I would add that depending on the change, sometimes we have more information than others. Sometimes by law, you know, the authorities are required to ask for public comment with respect to certain things. That is not always the case, but that obviously would be a good opportunity to help shape, you know, how things will end up. Also, the presidential administration, some are more willing to discuss things with chambers of commerce and industry, for example, than prior to making the actual changes than others. You know, some just go ahead and make the changes without discussing anything with anybody. So that's also an important factor. And I think also that in addition to gathering the information, the other piece is communicating it timely and proactively to companies. And to the extent that we can improve that process through organizations like the chamber, then I think that all of, you know, the chamber's members and our clients would be benefited.
Yeah, thank you. In our chapter, we have a North American working group, which is made up of 6 companies that have operations in Mexico, and we've been working very closely with them on issues that are important, and trying to get into the right offices in the government of Mexico to discuss these. And we've been fairly successful in doing that. Well, listen, I thank you all, first of all, for all the hard work you did in putting these presentations together. Again, we're giving a lot of people out there in our audience, not only our members here, but around the country, information that they need to move forward in this complicated world. We are going to have a number of webinars coming up. The next one is going to be the end of May on tourism. And then in July, the 2nd anniversary of the USMCA, we're going to have a 2-day event to cover a number of areas of the USMCA that I think everybody feels are important to find out what's going on as far as the implementation of the agreement is concerned. But before we leave, you know, I know the ambassador had to go off to another meeting, but I thank her very much for leading our sessions, our last 5 sessions. And we're going to continue this relationship in the future because I think it's very beneficial to both of us. But Rocio, I know you have something to say about a week that's coming up next week. Go ahead, it's all yours.
Yes, thank you, Ralph. Let me share with you that on a very different topic, we are having the first week of Mexico here in Chicago, and we are very excited. As you can see, we are having all these events. In this occasion, we are showcasing the state of Tlaxcala with these beautiful monumental carpets that are going to be displayed at Daily Plaza. So we really like you to join us. And next year, we are going to have the state of Jalisco as the invited state. So we will be looking for sponsors, and we will keep you posted about the Week of Mexico next year. So we hope you can join us for the events that we're having next week. If you can follow us in Facebook, Twitter, and Instagram, there you can find all the information. Thank you, Ralph.
Thank you, Rocio. Last week, I think we're getting, okay, now we're off. Thank you. Last week, the ambassador and Luz Najera, our president from Ingredion, and I had an excellent session with the governor of Jalisco at Casa Jalisco here in Chicago. And we see a lot of opportunity for working together. As probably most of you know, but not all of you, last October, we signed a memorandum of understanding in Washington with AMSTI, the Association of Mexican Secretaries of Economic Development. And we're going to be working with many of the states to improve our relationship and be able to provide information, not only for companies that want to invest in Mexico, but also companies in Mexico that want to invest in the United States. So we have a lot of good stuff coming up. And again, I thank you all for participating. The presentations and the video will be available by Friday. And if you want to get back with any of the speakers, please do so. Again, they're all members of our chapter. And in fact, Baker Tilly, Baker McKenzie, and RSM are actually on our binational board of directors. So anyway, thank you all again, and stay safe and be well. Bye-bye.
Thanks, everyone.
Thank you.